Since the U.S. Federal Reserve began jacking up interest rates in March 2022 to slow inflation, economists, policymakers, and investors have been calculating and recalculating its chances of achieving a so-called soft landing, slowing the economy enough to rein in prices without triggering a sharp rise in unemployment. A year later, inflation was dropping, but the debate still raged over whether the Fed was likely to land safely or overshoot or undershoot the runway. Then new turbulence was added by the biggest banking crisis since 2008. The bank failures were largely limited to the U.S. Other central banks faced difficult choices on whether to continue pause or reverse interest rate hikes. Recession, it's what many economists have forecast will happen as the Fed's most aggressive credit tightening campaign since the 1980s takes an increasing toll on the U.S. economy. If what's needed to squeeze inflation is too extreme, or if the Fed makes a mistake, what's been a persistently strong labor market could finally crack, leading unemployment to rise significantly and millions of workers to lose their jobs. It's not what Fed Chair Jerome Powell wants to see, nor Joe Biden is seeking another term as president in 2024. The U.S. ends up stuck with unacceptably elevated inflation. Many economists say that's what happened in the 1970s when they think the Fed failed to keep interest rates high long enough for long enough. Part of the problem facing the Fed and other central banks now is uncertainty over how long it will take the interest rates already in place to have their full dampening effect. That's making it harder for them to gauge when it's time to ease again. By April, the Fed's favored inflation gauge was running 4.4%, significantly lower than the 7% reading in June 2022. That's still more than double the Fed's official inflation target of 2%. Powell has insisted the Fed won't end the inflation fight until confident prices are headed back to the target. Yes, in fact, there's several. The most talked about is the soft landing, something the Fed has pulled off arguably once in 1994, 1995, under then Chair Alan Greenspan. The central bank doubled interest rates to 6% and succeeded in slowing economic growth without killing it. Finally, is what some economists call a growth recession. This oxymoron refers to a protracted period in which growth slows, but the economy doesn't actually contract. And in early 2023, there was talk of a no landing as the economy started the year with bang. Hiring surged, retail sales climbed, and home builders turned more optimistic, even as inflation eased. Under this scenario, growth reaccelerates after downshifting last year. In effect, the economy never really touches down. But by mid-year, the picture was complicated by explosions in the U.S. banking system. And made the landing even trickier. Banks were already gradually tightening lending standards before 3 regional institutions collapsed earlier this year. If financial jitters prompted banks to pull back more aggressively, the ensuing credit crunch could send the economy into recession. It's in part due to the tight labor market where unemployment is hovering around a multi-decade low. Employers are having to pay up to hire more workers or retain the ones they have to avoid having those costs pinch their profits. They're jacking up prices. Those higher wages are also giving households the wherewithal, at least for now, to pay those higher prices. Inflation is falling in most places, but at different speeds, leaving policymakers a variety of challenges. The European Central Bank raised its deposit rate to 3.25% in May from the 9% on more than 100 and rate. They can't range from on time May. The showing that raise it, screw raise that show how the quarter raise it was screw party some, unfortunately in the sand. Now, President Christine Lagarde has vowed to keep going with interest rate increases to bring inflation down to the central bank's 2% target. In the UK, inflation was 8.7 April, putting off the prospect of any quick end to the Bank of England's string of rate hikes. Across Latin America, inflation began to ease, but central bank leaders said that they were moving cautiously after having raised rates to double digits. Those increases had led to conflict with political leaders, most notably Brazil's President Luiz Inácio Lula da Silva, who criticized his central bank's decision not to budge from the 13.75% and set a key rate bet in August 2022, even as inflation fell sharply.